Please help this channel grow by hitting like and subscribe.
All right, today we're diving into the premium Chinese electric vehicle maker NIO. Now, for all its cool cars and innovative tech, there has been one very persistent question that has followed this company for years. You know the one. It's the question that pops up in every earnings call, every investor forum, and in pretty much every analyst report. It's kind of been the elephant in the room, casting a shadow over everything else. Exactly. After burning through billions and billions of dollars to build out its brand, its factories, and its network, this has always been the bottom line. When does this incredible vision finally turn into real, actual profit? Well, this month, we finally got a glimpse of an answer. It came in the form of a rare profit projection, a signal to the whole market that something big might be changing. And it all comes down to one number. That's about $140 million US. This is what NIO projects it will make in non-GAAP operating profit in the fourth quarter of 2025. Now, this isn't just some number on a spreadsheet. This is a landmark. This is set to be the company's first ever profitable quarter. So what does this milestone really mean? And how in the world did they get here? This single projection could signal a whole new chapter for NIO. But first, it's super important to understand exactly what we're looking at. Okay, so you see this term non-GAAP? And it sounds a little like financial jargon, right? Well, all it really means is that we're looking at the profit from their main business, building and selling cars. And we're taking out some other stuff like stock-based compensation. For a company like NIO, which is still in major growth mode, showing a profit here is a huge deal. It basically proves that the core business model actually works. So this profitability news, it's the absolute cornerstone of the bull case for NIO. But it didn't just happen in a vacuum. It's the result of some serious momentum that's been building up. So let's pop the hood and see what's driving this thing. First off, the raw growth is just wow. A staggering 77.3% jump in deliveries year over year so far. I mean, it's simple math, right? More cars sold means more money coming in. And that is the straightest line to profitability. They're not just growing anymore. They're really hitting the accelerator. And it's not just about selling more cars. It's about making more money on each car they sell. You can see their vehicle margin is just climbing steadily upwards, from about 10% to a guided 18% in just a couple of quarters. They are on a clear path to that 20% target, which is a really healthy sign for a premium car brand. And get this, they aren't just selling more of the same expensive cars. This shows their multi-brand strategy is paying off. While the main NIO brand is still the king, their newer, more affordable Envo and Firefly brands are already selling thousands of cars. This is how they plan to take on the mass market competition and reach a way bigger audience. Okay, so profit and growth are fantastic, but in the ridiculously competitive EV world, you need an edge, a defensible advantage, something that others can't just come along and copy. For NIO, that has always been its battery swapping tech. And the scale here is just immense. We're talking nearly 4,000 stations, over 100 million battery swaps already done, and they're planning to build another 1,000 stations this year. Think of it like a network of gas stations, but instead of filling up, you get a brand new, fully charged battery in minutes. It's a massive investment that really locks customers into the NIO ecosystem. Okay, that all sounds pretty great for the bulls, but let's pump the brakes a second. It would be a huge mistake to ignore the challenges ahead. The Chinese EV market is an absolute battlefield, and there are some serious headwinds picking up. So let's put those delivery numbers into perspective. NIO's 20,000 cars is impressive, for sure, but then you see Li Auto is still ahead. And then you see the true giant, BYD, delivering nearly 10 times that many cars in a single month. The scale of the competition is just breathtaking. This is a true battle of titans. And at the very same time, the government's role is shifting. That full tax break that basically fueled the entire EV boom, it's gone. Now it's been replaced by a smaller subsidy. This is a new test for every single EV maker, including NIO. Can you keep selling cars when they suddenly get more expensive for your customers? Now, this quote here, this is the sort of thing that keeps the bears and probably some executives up at night. In plain English, it means their short-term bills are bigger than the cash they have readily available. Now, NIO does have a strong cash position overall, but this is a financial weak spot they have to manage very, very carefully. So, you're facing down monster competitors and a shifting market. What's the plan? Well, NIO isn't just thinking about the next few months. It's playing the long game, and it has some pretty ambitious moves up its sleeve. Their long game looks like a three-pronged attack. First, they're going global, pushing into 40 different countries to find new customers outside of China. Second, they're investing in their own core tech, like their own chip company. And third, they're doubling down on that battery swap moat, rolling out even better and faster stations.
So let's just boil it all down, shall we? The bull case is all about this new profitability, the rising margins, and that one-of-a-kind battery swap network. The bear case? It's all about the brutal competition, that stressed balance sheet, and those unpredictable government policies. You've got two very powerful and totally conflicting stories here.
And that brings us right to the heart of the matter. With such strong arguments on both sides, how is the market supposed to feel about NIO right now? How do you value a company that's standing at such a critical turning point? Well, if you look at its valuation, the market seems cautious. Based on its price-to-sales ratio, NIO is actually trading at a bit of a discount compared to a peer like XPeng, and XPeng hasn't even hit profitability yet. That tells you that even with all the good news, that bear case is still weighing heavily on investors' minds.
But if you look at the professional analysts who cover the stock day in and day out, the feeling is much more positive. The consensus rating is a buy, and their average price target suggests there could be a solid 32% upside from where the stock is now. Clearly, they see the potential outweighing the risks.
And that brings us right back to where we started. The company has finally given an answer to that question that's been looming for so long. It's shown it can cross the profitability line, even if it's just for one projected quarter. And that is a huge step.
But one quarter is just one lap in a very, very long race. The EV market is a marathon, not a sprint. Proving you can be profitable is one thing, but sustaining it year after year in the face of all this competition and change, that is the ultimate challenge. And that is the question that will truly define NIO's future.
The content in this video is for entertainment and educational purposes only and should not be considered financial advice. All investments involve risk, including the loss of principal. Please do your own research or consult with a professional before making any financial decisions.